the tax situation there? Is that what you're
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, great. Well, welcome everyone. Brent Silverbauer here. I'm filling in today for Brett Swarts. He's the founder and CEO of Capital Gains Tax Solutions. And today we are talking about unlocking commercial real estate listings using the Deferred Sales Trust. It's good to see everyone here. Anyone, I have yet to meet everyone here. Brett just asked me to come in and fill in for him. And I'm one of Brett's partners in strategic alliances. And I've been working with him for exit strategies for highly appreciated assets, mainly real estate. I'm a commercial real estate agent, and to help them to exit without the use of a 1031 exchange using a deferred sales trust. So we got a bunch of people in here. Hey Taylor, how you doing? Jake Carpenter, good to see everyone here. I'm just curious, is there anything that you guys are specifically interested in learning about with the Deferred Sales Trust and Capital Gains Tax Solutions? He asked me to talk about commercial real estate, but if there's something else that other folks are interested in, I could jump off there and change routes or what.
Brent.
Hey Pierce, how you doing?
What's up, man? I'm good, brother.
Good to see you guys. Okay, well, let's just jump right in. Sometimes the best way to talk about things is just kind of sharing some case studies and some things that I'm seeing that has been really great. Let's see, I'm going to mute you, Pierce, there. So basically, one of the things that I've been able to help some folks with in terms of providing solutions with capital gains exit strategies is with real estate investors who own a portfolio of smaller multifamily or single family homes. Okay. So there's some folks that I work with, and they do well either in the tech sector or they have a business or whatever it is, And so they'll buy a house here, they'll buy a rental property there, a duplex there, maybe 3 year, and they'll carry this on, so forth and so on for 10 years, 15 years, and all of a sudden they end up with say 50 different houses, right? And they're all rental properties. Well, then they basically become a landlord. They have 50 different water heaters, 50 different roofs, 50 different landscapers. They have this huge portfolio of a somewhat complicated asset. And they want to trade that into a large multifamily, maybe a triple net or some other easier to manage, larger asset. But they hit a big problem in that to do a 1031 exchange well, the timing to sell, let's just say, for example, 50 different small properties and line it all up so that you're closing in the right time frame, that you have 45 days to identify and 180 days to close on all these different transactions is extremely difficult to do. And so basically what I've been working with Brett with is the option to do a DST. So as opposed to a 1031 exchange, doing a deferred sales trust. And this allows us to defer 100% of the capital gains on those appreciated assets. It allows us the time strategy and the ability to sell one house and then another and then another and then another without the 45 days to identify 180 days to close, all those time constraints, which is fantastic. And so they're able to go over a 6 months or a year-long process, sell all these smaller assets, put everything into a trust, and then on their time frame, go and purchase a large asset. They can go into REITs or different funds or things like that that are more passive and give them the time freedom and the ability to have the I guess just the creativity and to not be rushed by these different time constraints that are in 1031 exchange. Okay, so that's been a great tool to use to solve some of these folks' problems. And so I'm looking at everyone out here. Do you guys have, some of you guys are financial advisors, some are real estate agents. Does anyone know any situations like that would be helpful, or a scenario where someone owns a bunch of smaller assets and they're having a hard time trading up into larger or more liquid assets? Anybody? All right. Well, okay. So that's great, and that's just one way to do it. Another thing that I've seen that has been helpful is unlocking. So the title of this whole series here is, or this one Zoom is unlocking commercial real estate using the DST. And so one of the things that is great is that not a lot of people know about the ability to do a deferred sales trust. And so a lot of people think, even if they have a larger asset, we're working with a guy, large multifamily, $15+ million asset, and he has the mortgage on that, or the debt on that in the next year is going to increase dramatically. And there's a ticking time bomb from what a lot of analysts talk about in multifamily, where you have these adjustable loans. They have 3 years fixed, and then it goes to prime plus 2%, where their interest rate goes from 3.5% to close to 7%. And when you have those large loans, $5, $7, $10 million loans, that can be devastating for your cash flow. And so what they find themselves in this situation where they have to sell, they have to trade out of it, but they're selling and going into the same exact market. And so what the DST has allowed us to do is to have a strategy where, hey, you could sell today, go into a diverse amount of different funds. So say there's a $10 million in equity, you could put in 10 different things, and have the ability to have liquid assets, different funds where you can get out in 30 days, or different REITs or different stocks, all kinds of different liquid assets. It doesn't have to be like kind. It doesn't have to go from one multifamily into another commercial real estate deal. It can go into funds and other things that are more liquid. And this allows them to sell now when they have before their debt changes in an okay market. It's not a blazing hot market like it once was, but it's not terrible. Or could be what could be a much softer market with interest rates and everything, and then be on the sidelines and hold it for 10 years, 5 years, 2 years out of the commercial real estate market, and then the ability to come back in when things could be potentially softer. So any questions on that? I mean, I got a bunch of folks listening here. Or any applications that you guys feel like this could work for you guys in? Anyone in commercial real estate? Trying to add deals, transactions? Okay. And then has anyone done a DST in here? Is closed on a property using the Deferred Sales Trust and had a good experience with it that you could kind of share your story at all? Looking at Pierce, any of the Jakes, your experience? Okay. All right. Well, anyways, so great. Pierce, you want to say something? Oh,
I can help you out. Yeah, so we are at the DLP Capital event right now.
yeah.
It's actually lunchtime out here in New Orleans, but it's been an awesome conference. DLP Capital is one of our strategic alliances, and one of the cool things that we're doing now is they have a bunch of different funds that are earning 10, 12, percent on some of their housing funds and development deals and all that kind of stuff. So there's just a bunch of operators out here, and so on and so forth. And actually, that guy right there, who's eating, is one of the financial advisors as well, who's pulled off just recently a $17 million billboard sale. And one of the things that he said yesterday while we were doing kind of like our in-person mastermind was that, it was so complicated on the outside, but then like once we did it, it was just so smooth. And so I think that really kind of goes and just speaks to the power of having a team that's done it, all over. And don't be intimidated by the fact that, it looks complicated on the outside, because that's what we're here to do. We're here to help you navigate through that. And just really simplify it for you. And so that's the huge benefit of having the team, who's had the work and done the work like we have. So it's been awesome.
Yeah, great. Any good insights there at the DLP Capital event? Oh, look at this guy right here.
Look at that guy, dude. He's sick. He's like a fish just caught, man.
Hey,
How many we got on there? Oh,
That's good amount, dude.
Well, there's Jake. Oh, look at Jake. Looks good. Look how
Jake
good he looks.
does look good. I haven't heard Jake speak one time though.
Look at that. He came out for all the stuff just for us, Jake. We feel honored to have you looking so dapper.
I dressed up just for you guys. I put on a tie. This is like a once a year event, so enjoy. It won't last long.
Can't hear a word you're saying, but
Yeah.
yeah.
No, absolutely. It's good stuff. So we were just going over Joe's deal actually.
Okay.
The $17 million billboard deal. So we were just saying how, he was saying complicated on the outside, but once they did it.
Yeah, Jake Carpenter. Yeah.
And so how much easier it was.
Yeah.
Now that we're, doing it, and how easy the team made it.
Absolutely. And everyone's loving the taxable shirt here too, by the way. I literally just walked around. It's like a billboard. Like, hey, what's that? And one guy was like, it's like a 10-second handoff. It's like, wait, stop. And I was like, we're going like in the middle of the meeting. He's like, hey, just text me. He's like, just text me your information. And I just give him everything. But,
hey, Brett. While we have you here, you want to share a deal story of maybe someone going from a DST into DLP Capital? That seems to be such a good 1-2 punch. I love those guys over there at DLP, but maybe you could share just a quick story of that combo.
Yeah, absolutely. So DST into DLP Capital. So there's been many of those. In fact, gentleman that's sitting over my left shoulder now, he just closed on his second asset. He sold a business, and it's actually a deal Jake Miller and I. And they are out of Colorado. And he and his wife owns a business, and as of about a month ago, they sold that business. It was about $2.5 million. They had no base. It was actually it's going to be hit with a very high tax. They also operate multi properties, and so they 70s. Like anything, they're looking to get rid of the toilet trash liability, looking for opportunities to hire some. Talked about real estate with hands-on, get some cash flow, but they didn't like all the active day-to-day. So part of what they wanted to see in their investment strategy at DST was that people were also active hands-off, but they didn't introduce themselves. So I introduced them to DLP Capital, and a lot of those course of about 90 days or so. They love the lending fund, the flexibility with the basically get out with about 30 days, so about 10% average, as well as the housing fund, which is doing like 6 to 7 average per year. Pretty cool. So long story short, they sold their second asset to DST as of like a couple days ago. Right now we're actually getting Big Miller allocation for percentage of the fund. And the other funds are DLP lending fund, and they were working on some of their housing fund. They also just told me today they have an extra $3 million that's just sitting on the sidelines outside of the DST that they're probably going to putting in a lot of the DLP. So I think the biggest things for DLP, what they love about them is the no like and trust track record. They're very transparent. They're hands-on. They have these amazing events like this where people are meeting and like build well. And so all of these things are why it's cool. Is that a good share, Brent? Or any nuggets to pull to that?
Yeah. Thanks so much, Brett. Really appreciate it. Definitely. So yeah, Brett was you were kind of breaking up just a little bit, but I could make out a lot of what you're saying is that DLP is they're asset manager. They invest in a lot of real estate. They do hard money loans, all kinds of different things. And they just had a long track record. I think they have about $4 billion under management, if I'm understanding that correctly. Great 5 now. Okay. So great track record of giving great returns for clients. The housing fund, which is investing in the housing shortage in America, was returning, I think, on average 20+%, something like that. Is that right? And then they have a lending fund where they're lending on different things, and that was returning anywhere from 10 to 12%. Is that about right, Brett? And the great thing about that fund is that you could exit out of it in 30 days. So it's fairly liquid. And so that allows you to take your money out, get that 10% return. A lot of times when we do the calculations on return on equity for some of these guys who are holding multifamily assets, I mean, their return is, maybe 6-7% cash on cash return. So not only do they not have the tenants, the termites, the trash, are we going to do remodels? Oh, we got to do the roofs. All these decisions, which takes their time and energy off of, whatever they want to be doing and onto repairing, real estate. And it allows them to have that time freedom. It allows them to have that freedom in their mind to focus on what their business or whatever else it is, and have a greater return, a greater cash on cash return. So we're doing the math. We're putting up together spreadsheets. We're saying, hey, look, you could hold this asset, which with a debt that's going to increase in 1 to 2, 3 years, or you can trade it into, DLP capital, lending fund, housing fund, whatever fund you want. The return on your cash on cash return is going to go up. We're going to get you more cash flow. We're going to have less problems that you have over here. And it's more liquid where you could trade out of that and go back into real estate whenever you
nailed it, Brent. Especially for anyone in California is looking at cap rates that are still really low, and you're looking at huge appreciation. And there's the whole Sun Belt shift been going on for years, but it's even more dramatic, I believe, as policy and taxes continue to increase. For people moving to the Floridas, the Tennessees, the North Carolinas, and Texas, and that's going to create even more opportunity for housing to grow there and rents to grow where they're not in rent control states. So all of these things are pointing towards why you want to diversify and get out of highly appreciated assets, especially in tax exempt, like Sacramento and Chico in the Bay Area. Southern California. You want to sell high, defer your tax, pay off your debt. Then if you can increase your cash flow, you can go to Deferred Sales Trust, which you can increase the cash flow by 30, 40, 50, 60%. Right? And it's incredible to see what your NOI is now versus what it would be with the Deferred Sales Trust. And all the while lowering your risk. Now, it does take getting to know us, getting to know DLP Capital, getting to know what options are available. But once you understand the power of the DST with proven operators who have tremendous experience and a track record, culture, and leadership, it really part of why we're events like this, to learn from those other operators across the country. So those are some of the cool things there. So I'm going to pass it back to you, Brent. I got to get back to a lunch meeting with another potential client who might be closing on an asset with us. So that being said, Brent, thanks for filling in. I'll pass it back to you, brother.
Thank you, Brett. Appreciate you. All right, cool. Well, there he is, the man, the myth, the legend himself. And apologize for my casual Friday attire. We got Jake over there looking like $1 million. You know, Brett's like, hey, just jump on this Zoom, run this. And so I wasn't expecting this, but it's good to be here with you guys. Any questions about kind of what Brett said and some of these strategies? I mean, are you guys familiar with this? Is it new to you? Give me a little bit of feedback here. Anybody?
Hey, Brent, how's my comm here? Can you hear me okay?
I can hear you just great.
Excellent. Wonderful. Well, I know that Tyler here in the group, we've discussed a few different options with him on the Deferred Sales Trust. One of the big and important things is, hey, if we jump in to this opportunity to sell, and it might be the biggest transaction we've ever had in our life, right? What are we trading that for? Meaning, what is our actual objective with the money, with the cash, with the liquidity that we have? What are we going to invest in? Are we going to move from one asset into another asset that's going to give us something different that we're looking for, right? I know that, Tyler, we've had a lot of conversation about that, but also other people here in the group, Jake Carpenter, you know, a lot of times as financial advisors, we meet with people and it's all about what is the goal behind the asset or what is the goal behind the investment? Is it that we need income? Is it that we need growth? Is it that at some point down the road, we're going to leave a legacy? And so everybody invests for a different reason. And it's really important that our assets align with our investment goals and objectives. And so I just kind of wanted to throw that out there for a little bit. Know and understand why it is that we invest. Yes, we might get a rate of return. Yes, it might be aggressive or it might be somewhat chill. You know what I mean?
Yeah.
But it should align with our goals of what we're hoping to accomplish.
Amen. That's exactly right. Yeah. And, you know, that's why I kind of like the DST because, you know, like I gave an example of just a family who just continued to buy duplexes and single family homes over 15 years, you know, and obviously it was great, you know, somewhat passive income owning real estate, semi-passive. But yeah, it's the flexibility to not be stuck into a like kind exchange from, you know, commercial real estate into more commercial real estate. I think is great. Just like what you said, it's like sometimes you need this type of asset or that or this reasoning, and sometimes real estate is not the answer, and sometimes it is. And that's the cool thing about the DST is it allows you to change asset classes as well. You know. And
I think Tyler, you unmuted there. You want to comment?
I'm just here to learn. This is all new to me outside our conversations, but it does seem right up my alley because I got what I would think is a good offer for my property and my business. But looking out there, there's not a lot of options for 1031 and there's not a lot of good deals. So this kind of does seem like something that fits me pretty well.
Yeah.
So let me comment on that a little bit because the challenge for a business owner, there's two kinds of business owners, right? There's one that owns a business and runs a business and also owns the real estate or the building and the location that you're at and or multiple locations, or there's a business owner that owns the business but leases the buildings. So for the business owner that owns the real estate that those businesses are ran out of, you do have a 1031 exchange option with the buildings, but not with the business.
Right.
And so this is where the Deferred Sales Trust can bring in some options for a business owner looking to sell because now you can defer the capital gains tax on the sale of that business without having to use a 1031 exchange because it doesn't qualify. So this gives you an option to defer the tax on the entire transaction. And some business owners want to sell the business, keep the real estate, lease it back to the guy that's buying the business. Some of them want to sell both the real estate and the business. And again, what I think all of us like about the Deferred Sales Trust is that it gives us the maximum flexibility to sell the business, keep the real estate, sell the business and the real estate, do kind of whatever we want to do, and not have to go back into like-kind property or not have to go back all into stocks, bonds, and mutual funds. We can go right back into other businesses. We can go back into real estate. We can split it up. So, there's a lot of power in being able to have those kinds of options, especially when you're a business owner.
100%. And Jake, have you done I don't know anyone here really. Have you done a DST? What's your experience with Brett?
Yeah, so I've been working with Brett. Actually, we brought Brett up to do some guest speaking for our group. But I've been working with Brett for about 6 years.
Nice.
We've done multiple deferred sales trusts and, more and more all the time. And I also work a lot with Jake Miller lately, Micah Miller and their team. So really, we're just kind of this big group that works together basically for the benefit of our clients. And, so it's kind of a really neat relationship. But yeah, I've been doing this for a little while. And I feel like the opportunity is just continuing to grow because really nobody knows about the Deferred Sales Trust. And, everyone asks me, well, why, if it's been around for 25, 30 years, how come no one's heard of it? And it's very simply, the 1031 exchange has worked. And it seems to be a little bit more well-known on the East Coast than on the Western United States, which is where I'm at. I'm in Washington State and do a little bit more work up and down the Western United States. But yeah, I've been working with Brett for a while, and this has been a really powerful tool for me to help my clients and diversify out of really over concentrations in specific kinds of asset classes and specific geographic locations.
Awesome. Yeah, great. Yeah. Yeah, and in commercial real estate, you know how it is when you engage that 1031 exchange, how stressful that is, and the 30-day options and the 40, and and you're selling in the same market. So if you sell at a 4 cap, oh great, I got a 4 cap. Well, everyone else is, in that same, you're going to buy a 4 cap. The ability to sell in one market, wait, diversify, kind of be more liquid and get back in at your pleasure. I think it's such a powerful thing that I don't see that in any other. I don't see any other ability outside of that DST to do that. Do you?
Recently, I just had a conversation with a gal out of Wyoming who's a younger gal, and she has a really great, real nice young lady, nice about $7 million portfolio of real estate. And it was interesting where we went with the conversation, because the conversation for her was, I really like the idea of selling. And after she services the debt, she'd have about $5 million of proceeds for the Deferred Sales Trust. And she says, Jake, I just would love to just kind of hit pause for a couple of years and then kind of reevaluate and decide whether I want to go back into actively managing real estate. And I says, well, okay, well, tell me about why that is so appealing to you. And she says, well, I'm pregnant with my second child. She says, I'd like to take, maybe 5 or 10 years and focus on the kids. And then at the end of that time, would there be a way for me to get back into actively owning real estate? And the Deferred Sales Trust can give her that option. She can sell, she can move into diversified real estate syndications, not necessarily be all in the stock market. And those syndications generally have a 3-year, 5-year, 7-year, 10-year hold. They cycle through. Meanwhile, they're just paying income. So she's just taking in income over time, no trash, toilets, tenants, liabilities. And then we can pop our heads up 8 or 9 years down the road and go, hey, what does life look like for you now? Would you like to take, now that these syndications are turning over, would you like to take this capital and maybe redeploy up to 80% of what's in the trust through? So what we do is we form an LLC. She becomes the general partner and the trust becomes a limited partner, giving or lending the proceeds, providing the proceeds to go and do some of those actively managed ventures. Should she decide in 8 or 10 years, she wants to go out and kind of do it herself, the trust provides that kind of option for her to do that as well. Or she can just say, hey, I just like to stay passive, but you can always turn it off or turn it on as far as passive and active whenever you want, and continue to achieve deferral.
Yeah. Now with the depreciation, that method that you just said, the 80-20, going into LLC, going back into actively owning real estate, you get a new depreciation schedule. Is that correct?
Absolutely. And that's one of the powerful tools that allows you to take advantage of.
Yeah. So you can depreciate an asset down, correct? DST, and then form a new LLC and put 80% of the trust funds can loan to that LLC to go, and you're the general, and then the trust is the limited partner. Is that right? And then basically go buy another asset and then have a brand new depreciation schedule, correct?
Correct.
Yeah, that's unbelievable. I mean, I don't know anything else like that.
But we can't achieve that through a 1031 exchange because the depreciation schedule follows us. So
yeah. I mean, wow. Yeah. So it's pretty powerful. It's powerful. I mean, it gives you the flexibility and the freedom, just like, let's see, Jake was saying, to do what's best for the client. You don't have to trade into another piece of real estate. You could analyze the current life situation and suggest, whatever fits that situation.
It's a lot of fun. Sometimes we run into Jake Miller and I worked on a really neat case with Brett where this guy had a lot of debt over basis. So we had to go into a 1031 first. We had to replace and deal with the issue of debt over basis first through a zero coupon Delaware, which is basically you take a little bit of capital to replace a lot of debt. And that freed up capital that could go into the Deferred Sales Trust. So then it flowed, the proceeds flowed a little bit into the 1031 and then through to the Deferred Sales Trust. So it's a really neat, there is so much flexibility in working with a professional team like Jake Miller, Micah, myself, Pierce, some of these other guys. We all work together to make sure that the job gets done at the end of the day, which is, it's quite a blessing to work in a group like that, because not everyone plays fair in the sandbox.
Yeah. It allows you to enter into this kind of infinite universe of creativity, I feel like, where you're not kind of in this 1031 box, but there's a lot more flexibility and creativity. Thanks for sharing. I love those stories. And it's good. And it's good to meet you too. So maybe we'll see each other at an event at some point in time.
Good to meet you too.
All right, great. Well, our time is up. Anyone have any more questions or comments? Cool stories?
I have a question about the structure of control in a DST. What do I have total control of what that money is spent on? What someone could explain that to me in more detail would be awesome.
Yeah. I want to change the language there just a little bit. I want to say that you have control, but you give up control for purposes of the tax deferral.
Right.
But you still retain control in the sense that you and the trustee work hand in hand. There's a dual signature process for everything. At the end of the day, the trustee takes on that fiduciary responsibility for the assets of the trust. You, however, are still the captain at the head of the ship. But now you've got an engineer in the boiler room. Now you've got people on the lookout. You've got this team around you to help make the entire thing possible. You want, if for any reason the IRS comes looking, you want the trustee to be the one in control so that there's a continual deferral. So let's talk about terminology a little bit. In essence, you are giving up authority and control to the trustee. Assets move into the trust. The trustee takes on a fiduciary responsibility for those assets until they are liquidated, or when I say liquidated, that's perhaps a point in time, but until the trust itself is terminated or the assets are taken out of the trust and given to you. In the very beginning, let's talk about how this trust works. There's the buyer and the seller of some capital asset, right? We stick the trust in between the buyer and seller so that we do not, for the seller, recognize the transaction for tax purposes now. We essentially are putting the trust in the middle. And when we do that, we exchange the asset. Let's say it's a piece of real estate. We put the asset into the trust then sells it to the buyer. In the beginning for the exchange, you had to exchange something of similar value, which we typically use a promissory note. So you change from being an owner of the asset to a creditor of the asset. And that's actually very important. If you were not the creditor of the asset, then you would not have legal rights to the corpus of the trust or to the assets inside of the trust. Becoming a creditor of the trust, now you have ultimate power and authority should you need, and that's important. Let's talk about this a little bit. Everybody's had a mortgage before. Everybody's known the house, right? And Tyler, what happens should you stop making payments on that house?
I'll get a phone call.
A phone call, letter in the mail, knock on the door, something like that, right? And then it just depends how long you go without making a payment. People go to extreme circumstances, but essentially, even though you are the owner of the home, who has ultimate rights to the property should you stop paying on that loan?
Well, eventually the mortgage company.
The mortgage company, the bank, whoever you want to call it, right? Now, we want you to be in that position in regards to the assets of the trust. So now we're going to take ownership away from you, but we're going to give you lendership. We're going to give you creditor rights. And not just of a home, but of a business, of crypto, of whatever asset that you want to be inside of the trust, right? And we do that because one, you have to give up some power and control for this to work, for it to be a true deferral. Otherwise, you have taken constructive receipt of the sales proceeds. If you take constructive receipt of the sales proceeds, you then pay taxes. So we are deferring that constructive receipt, but we still give you ultimate power and rights to the assets as a creditor.
Right.
And so that's incredibly important. But and of course, as we've all mentioned, now you're part of this great big team. Oftentimes you work with the trustee. Sometimes you work with different financial advisors, what have you, so that you can have the very best deals brought to you that are possible. But the structure of the trust, if I were to break it down one more time and just say it again, but ultra simple, I would say you have this trust. We move assets into the trust. The trust then sells the asset. The trust receives the proceeds. Inside of this trust, or this candy wrapper, so to speak, you can buy and sell like a 401k. You can buy and sell all day long, and you're not going to recognize any of those transactions for tax purposes. Because now, because of an
and you mentioned some sort of dual signature process, there would be nothing could get done without my signature. Is that correct?
That's correct, because you are the creditor. You, as the creditor, have to approve of a change in the assets inside of the trust.
Gotcha.
So, if it's marketable securities, trustee has to sign. You have to sign on how we deploy proceeds in the marketable securities. Should you invest in marketable securities until there's that next big business opportunity, and maybe it's 3 years down the road, maybe it's 6 months down the road, whenever that opportunity happens, well, again, there's an analysis that's done, there's some paperwork that's documented, and you liquidate assets in the market, you deploy the funds into that next big business opportunity. And of course, you got this team to help you know and understand, does it make sense for me to do this joint venture? Does it make sense for the trust just to own it? there's a lot of different ways that the trust can dovetail in on all these deals. And that's why you've got this team around you to help you know what is the best and most preferred method to optimize the purchase, optimize cash flow, optimize tax flow.
Gotcha. It's
Not
not
every deal is the
very
same.
common that both people don't agree on something. If I wanted to go sign a business and the trustee goes, it's not a great idea, I don't want to sign that. That's not happening very often.
That almost never happens unless, you know, the client wants to do something illegal, then the trustee says, no, you can't do that.
Gotcha.
So some kind of extreme circumstance, or if the trustee sees maybe a risk that the client is not aware of, the trustee sees maybe another opportunity in the same type of investment that the client wants, the trustee doesn't ever put down the brakes. He might pause something, he might bring something to your attention, but the trustee doesn't stop you from doing what you want to do. At the end of the day, the creditor has to approve of all asset changes inside of the trust.
Cool.
And of course, if the trustee needs help or assistance in some financial nature, somebody with a license, whatever, that's where, you know, Jay Carpenter, myself, and other experts, subject matter experts come to the table.
Right on.
We got people like JC here in the room, Micah, who's an insurance expert, and we got Casey, who's a tax expert. You know, it takes a team to help people achieve something of this magnitude, where literally people are saving hundreds of thousands of dollars in taxes.
Yeah. Yep.
Anyway, Brent, what do you want to add there?
No, that's great. Yeah, you have a friendly arm's length trustee. So they're friendly. They have to be arm's length to keep that taxes, but you know, they're there to serve you, basically. Okie doke. All right. Well, this is great. Thanks everyone for coming. I'm going to shut it down now. But we appreciate it, and we'll see you guys all next time.
Have a good day, everybody.